Hello, I'm Pat O'Hare, Chief Market Analyst for Briefing.com. Today is Thursday, April 30th. There's one thing that is clear this morning. The market is not getting caught up in the swine flu scare. Late yesterday, the World Health Organization raised its alert level to 5, leaving it just one notch below the pandemic indicator level, which the WHO thinks will be reached anyway in short order. Despite that thinking, the S&P is up 1.3% about 90 minutes into today's session. It is likely that end-of-month activity is playing a supportive role here, but we would not get too carried away chasing that trade. The gains Wednesday were impressive in size, but there wasn't a great deal of size behind them. Volume at the NYSE was 1.47 billion shares, which was well below the 50-day simple moving average of 1.71 billion shares. Additionally, the market is inching closer to the 900 level, which is apt to generate its share of round number resistance. In corporate news, there is a lot of talk this morning about a bankruptcy filing from Chrysler being imminent, as talks broke down last night with its lenders. Also, there has been another large batch of companies that reported earnings results, and sticking with the trend, most of the companies beat estimates. Procter & Gamble, Dow Chemical, Comcast, Starbucks, Visa, Cardinal Health, and Colgate-Palmolive are in that grouping. Separately, the latest initial claims report brought more of the same, with initial claims of 631,000 showing improvement from the prior week's level of 645,000, while continuing claims worsened to 6.27 million from the prior week's level of 6.14 million. The underlying message is that the pace of layoffs is slowing, but that finding a new job hasn't gotten any easier. The 4-week moving average for initial claims came down to 637,250 from 648,000, while the 4-week moving average for continuing claims jumped to 6.076 million from 5.944 million. What can be easy to overlook in the, quote, positive initial claims number is that it still suggests we'll see another huge decline of 500,000 plus in non-farm payrolls for April. Accordingly, notwithstanding the spending increase evident in the Q1 GDP report, there remains ample reason to be concerned about the pace of consumer spending in the months ahead. On that note, there was a generally positive assessment of the increase in real personal consumption expenditures in the GDP data yesterday. That was overdone. The fact is that the 2.2% rate of increase in real consumer spending for the first quarter was a result of a solid bounce in January and February after very poor December spending levels. The March data today shows a 0.2% decline in real personal consumption expenditures, which is consumer spending. There is no convincing uptrend, and the January and February gains may prove an aberration. Personal income fell 0.3% in March as wages and salaries retreated. That isn't exactly about to fuel further spending gains, especially in a period of tight credit. The economic data this morning isn't too swell in our estimation, yet the market has had its bad news blinders on for the time being and is higher in the early going. I'm Pat O'Hare for Briefing.com. Thanks for listening.